Well, Dave, I know we're coming through the season where we go out and we do a lot of manager meetings on site where we get to sit around with the people who are running the real estate in our portfolio on a day-to-day basis and really getting what's going on the ground. And so this is a part of the year where you and I travel all over the country and the world to meet with these folks. And it's a good time to sit down because I think there's a lot of interesting things happening in the real estate market today. So with all of that fresh information, let's talk about kind of the three pillars of real estate that we talked about last year with Dr. Lenneman. Very simple asset class. We call them the three legs of the stool. It's what's happening with the demand for real estate today. Where are we at from a supply standpoint? And then that third leg of the stool, we'll dive into what's happening with capital flows.
Sure. It's a really interesting time in the real estate market because what we've seen is increases in labor costs, construction costs, and financing costs, which makes it really challenging for developers to make new underwriting work for new development. And what that means is supply falling off a cliff. We've seen about 70% decrease in new supply in 2025,
Wow.
and projections for new pipelines going forward continues to be very muted. So as a landlord, it's very good in terms of pricing power and our ability to help grow NOI and increase property values.
So let's talk about that. What is NOI, and what are our managers, or what's the combined forecast for our underlying portfolio today look like?
We're pretty excited about where we sit today. So NOI is functionally the net income that a property can generate. That's a combination of growing revenue and decrease in expenses. Our current underwriting is projecting about a 5.5% go forward 12-month NOI.
All right, let's pivot and talk about demand, because that's the other side of that coin. If you have no supply but no demand, I'm pretty sure you're not going to have that pricing power that you're seeing in the market today. So what's happening within the portfolio from a demand? What are some of the metrics that you use to try to get an understanding of that? And where are we today relative to some other historical time periods? Are we above normal, below normal? What does that look like?
So demand has been very strong. We've been very pleased with our portfolio and really sustained demand. If we look at today, excluding office properties, which have their own unique challenges with the work from home environment, the current occupancy is about 94%. But if you compare that to a different point in the cycle with the GFC, that comparable metric was about 89%. So as we sit today, supply and demand and really real estate space market fundamentals are in great shape. We've seen continued absorption, especially on the multifamily side. Going back over 30 years, we've seen one of the best quarters in the first quarter of 2025. In industrial, we've seen really strong drivers like e-commerce, onshoring are going to be really helpful things for industrial going forward.
What about the alternative sectors, and how are those positioned on a go-forward basis?
So as we think about alternative sectors, these are really sectors that include seniors housing, student housing, data centers, self-storage. We've seen more and more institutional demand for these types of investments in portfolios. They provide diversification. They've got different drivers of demand. For example, we're seeing tremendous demand growth in the seniors housing space. We think it's going to be one of the best performing sectors going forward.
So the third leg of the stool is capital flowing into the asset class. And really this is the key to have the recovery that we're expecting. And what's really creating this generational opportunity is you're coming in at a great basis, well below replacement cost. You have limited supply that you talked about coming online. You have strong demand. But for that really to turn into returns, we need the spigot to turn back on with capital coming back into the market. What's happening there today? Where do you see that going? And how do you as an investor think about the timing for capital to move back into this asset class that has really been unloved for the last couple of years?
That's a real good point. we've seen a ton of green shoots in the real estate space. As we've talked before, this has really been a tale of two cities with the space market fundamentals that we just discussed, and then also the capital markets. The capital markets, there was significant repricing by about 25% overall in real estate since the peak, which really creates a floor and it provides a great basis to be coming in. Our expectation is more and more institutions will continue to increase their capital allocations to real estate as they just recognize the pricing has come off their peaks and is a really good entry point going forward.
So let's dig into that a little bit. What are some of those green shoots that you're looking for with capital flows? Again, the spigot hasn't turned on all the way yet, but what happens first in the institutional capital, and then when does retail start to make that turn as well?
So there's a couple different factors. One is the transaction markets opening back up. Another one is the credit markets, and we've tracked. It's called the CBRE Lending Momentum Index. That's up about 90% year over year. These are great tailwinds for us, and as we see more and more transactions occurring, that should be a good driver of real estate pricing. And I'd also note the first quarter of 2025 was the third straight quarter of positive total returns, which to me just says we've clearly gone past the trough in the real estate pricing.
Certainly, and so when we think about transactions happening, that means capital is starting to flow, and you've seen that turn. That means you start to see positive appreciation again. The income profile that you talked about, because of that growing NOI or net operating income growth, has been really positive. It's really the early innings of capital coming back, and some of the things that we've been talking about internally is we're seeing large institutional investors who were looking to redeem capital out of the asset class and out of the funds that we invest in, start to rescind some of those redemption requests. We've started to see not only those rescissions, we've seen new capital commitments starting to make their way through the market. And we would expect more of that activity as we go throughout the year. I do think ultimately the uncertainty around tariffs and trading and where we end up ultimately has slowed some of that capital commitment that we thought was really going to pick up by the middle of this year. But out of your most recent meetings, what are these managers saying? What are the people who are running the portfolios for us saying about capital flows and transactions?
I would say I think you're spot on with that. As the increased uncertainty is likely going to delay some of these decisions going forward by a quarter or two. But that being said, we're also seeing investors, really place capital in their highest conviction sectors. We've seen, as you mentioned, significant rescissions. We've seen capital redemption requests be cleared. And one thing I like about real estate is it typically repeats itself. And if you look back towards the GFC, the funds that had large redemption queues pivoted to capital contribution queues very, very quickly. Our expectation is that we're at about that point in the cycle where we're going to start seeing that money flow turn back on quickly.